Okay, hi everybody. It's Catherine Sumrall with Real Estate with Catherine at Keller Williams Realty, and we're coming here with you today to have a conversation. And so, a little bit about myself. I've been working with Keller Williams Realty for the past 7 years, serving our Durango community, and I've had the blessing of serving 130 families. And the reason why I'm coming to you today in this conversation series platform was I felt this need to step up not only as your real estate partner, but also a community partner as we all navigate through the interesting times that we are presented with right now. So with that, I do have a guest speaker with us today. Bill Clements will be joining. He is with the Clements Group here in town, and he's an accredited investment fiduciary. And I have to say that Bill is a wealth of knowledge when it comes to investing and finance and counseling clients through opportunities. So I'm excited to bring him on. We are actually going to, I'm going to get my screen share here, and well, I'm about to hand you over the mic.
Perfect. Thank you, Catherine. First of all, really want to thank you for your leadership, both in this moment, but also as you've helped families locate and relocate here in Durango and surrounding communities. And really, my focus today is to educate folks and make sure that they understand what their money's doing and have a game plan to be great investors through this event and probably the next 2 or 3 as well.
Sure. Love it.
With that said, welcome to our dog and pony show. Like good dogs and good ponies, we're wearing our face mask and we're staying away from other folks. And for the first few moments, we'll just look into my crystal ball. A small bit of disclosure here. Markets are uncertain, and when they are uncertain, they tend to be very volatile. That volatility both presents opportunity and challenges. And nothing I'm saying here is meant to be advice in lieu of what's going on with you and your plan and your financial advisor. So please talk to them, make good informed decisions. But I will try to give you a sense of what I see. Let's look at the markets in sort of 3 phases. What's going on with our economy and what was going on at the end of last year, what's going on now, and then what will be going on maybe towards the end of this year. Next, let's look at our markets, and we'll focus a bit on both equities and on bonds and what's gone on with them this year, and then where they might go in a broader section as we talk about this quick market update.
Wonderful.
First of all, in terms of our broader economy, just last quarter in this dog and pony show to our 401k companies, we said that earnings were about the best they'd ever been and that employment was about the best they've ever been. When I went to pull that for this show, we found that we could not find an earnings or an employment forecast from the major houses, the Merrill Lynch's, the JP Morgan's, because they just don't have enough data to produce it. But in my conference calls, I've heard numbers between 15 and 35% reduction in corporate earnings across the US, the S&P 500 kind of companies. That's an awfully broad range, and I think it's worth noting. As well, when we look at unemployments, I had this beautiful chart that showed weekly unemployment claims between 1950 and today. And today, we had 6 million unemployment claims. In every decade prior to that, the highest spike was something less than 1 million. So we really see a lot of uncertainty in our economy, but yet our economy is pretty solid, unlike a 2008 or a 99-2000. We had great earnings. They didn't seem to be out of line, but we were a little late in our economic cycle. I hope everybody understands that basic economic outlook and that ultimately translates to investments, whether that be real estate or stocks and bonds or anything you might invest in.
Wonderful. I think it's great to get have perspective to the differences in what we're experiencing now versus the last economic shift.
Excellent. With that said, I'll bring us into our second slide here.
Perfect. You just tell me, and I will.
Back one if we could.
Yeah, there we go.
I know everyone is just beat to death with COVID-19 disclosures, but I wanted to share another little mantra you could say as you were washing your hands. I'll be dollar cost averaging through this investment cycle and many more. There will be good times and bad, but I have a plan and will keep my discipline, for this will help my retirement income. I think it's really important that people have that discipline and that they have a plan. And I think the people that feel pain right now are those that don't have a plan or are misinvested. They're 20 years old and they should be an aggressive investor. And instead they're invested like they're 50 and they're moderate, or vice versa. If you're 50 years old and you should be invested moderately, but you're invested aggressively, this is a real scary, painful moment. And I don't recommend knee-jerking or making changes on the fly here, but what I do recommend is that folks think about their plan and they think about a logical way to influence that as we come out of this market correction, either way, to be more or less aggressive. As I talked in our opening slide, I mentioned that we would talk about economics, and then we would talk a bit about markets, which brings me to our next slide. Really, I just know two things about markets, all markets, frankly. One is that they hate uncertainty. I think many folks in our community and many communities nationally and even globally face uncertainty. And so that's a real problem for markets. On the top right, you can see where our market dropped quite a bit because of this event. Additionally, I know that markets have a tendency to climb a mountain and fall off a cliff, but that if you're invested over this whole 30-year run, almost 40-year run, you are very, very happy because you've made great returns. And so I want investors to focus on a long-term discipline. I'll also share our philosophy here at the Clements Group, which is that no one can really time the market, but that with a good process, you can reduce risk by avoiding trying to call the red X's, but rather reducing risk at the green arrows and then increasing risk at the green arrows on the bottom side of these big changes. And so, folks, I welcome you to use our philosophy to your advantage as you deal with this situation. Once again, I'll pause for a moment. Any questions?
I'm not getting any right now, but those that are joining on Zoom, feel free to feel free to raise your hand and ask questions as we go along.
To continue my market thoughts, what I really see is that our markets were very stable. They were high priced, but not overvalued. And then we had a shutdown, and we can't decide whether that shutdown is going to last a month, 6 months, somewhere in between. And the market will continue to see a lot of volatility until that question is resolved. That becomes important is, can we restart our economy? And today you'll see I'm a little scruffy and need a haircut. And I think this is a great example because I'll go get a haircut as soon as I can, and it's the right thing to do. But unfortunately, while that equals some pent-up demand, I can't go get 4 haircuts. And so probably some of that business is lost. To me, that means I think our economy and our markets will recover more like a check mark. They dropped off the cliff and then they will climb back up that mountain. Next slide, please. Next, this is a basic chart of investor emotions sort of overlaid over a market curve. And I really like to address what my 401k guy calls the water cooler tip. You get this great tip at work that you should buy this hot stock. 9 out of 10 times, you invested in that somewhere between excitement and over confidence or overabundance. And then the market forces step in, as they so often do, and the market drops out. And because you bought it at the wrong place, now all of a sudden you have this tendency to sell it somewhere between panic and despair. Catherine, if you'll hit go on the slideshow one more time, a little sticky note will pop up. The lesson here is that we want to buy low and sell high. And so we need to act as prudent long-term investors. And we need to fight our emotions to buy when we're overconfident and to sell in that moment of despair. This will move me on to a little education about the CARES Act and one more opportunity to pause for questions.
Well, and I just want to bring in the point of, I think that this slide is, may seem very simple. It's very powerful because one of the things that we operate in my world, which I think really parallels with what you're talking about here, is keeping emotions in the lines. You know, your emotions drive decision, and it's important to work with a provider, a service provider, a professional that will help you to keep your emotions within the line, respective to the data that's out there, respective to that area of expertise. So I love that you brought this up because people are emotionally processing what's happening in their world, right? Money is an emotional conversation. And so I just love that we brought this into the into the dialogue today, because as people are processing their emotional state, engage with your financial advisor, ask the questions, engage with your banker, engage with your realtor, engage with those people that can help you to keep your emotions between the lines and help provide perspective, which is my whole intent here. So I think this was very insightful and impactful from my perspective, Bill.
Catherine, truly, I agree with you. Your professionals should work for you. And these are the moments where you lean on them to be a great sounding board so you don't make a knee-jerk or a bad decision.
Right.
I'll have you flip to our next slide.
Perfect.
A lovely little index disclosure I have to put into our presentations. Just saying that the S&P 500 is a market composed of 500 widely held stocks here in the U.S. The Dow Jones Industrial Average is 50 stocks, and then we use the Vanguard Bond Market ETF as a proxy for the broader bond market. Once again, next slide. So this brings us to some education about the CARES Act. And really, Catherine, thank you, and Jack Llewellyn and Region 9 for tremendous information on the CARES Act. I have a few bullet points which will re-summarize what they've already said, but I'll focus on just one new item. Again, next slide, please. From my viewpoint as a financial advisor, many families don't have enough rainy day fund, and that's coming home to roost today. And so what we see is some personal stimulus checks which are meant to bolster the individual's rainy day fund. I often think of the PPL and the DDL loans also as bolstering companies' rainy day funds. And then finally, in that CARES Act was a provision that allowed you to take money out of your 401k if you had either an in-service distribution or a loan provision in that plan. So for many of you that work for a little bigger company with a 401k, be sure and ask your HR person or your employer about that if you need it. I really encourage folks to have this as the last source of funds you tap. It will derail your retirement. You still have to pay taxes on it, But if you need the basics, food, shelter, transportation, this is a resource that's here for you, and your plan may be able to loan or distribute that to you. And so it's an additional rainy day or savings plan. Your financial advisor or a member of the Clements Group can definitely help you with these questions.
Wonderful.
Once again, next slide. This brings me to a few opportunities. Rarely do we see our markets go on sale 15, 25%, depending on the sector you're looking at. And so if you're not contributing to your IRA or your 401k, and you can afford to right now, you've put a few dollars in your rainy day fund, or you haven't completely tapped it, this truly is a great time to put some money in the markets and get it to work. As well, if you're working a bunch of overtime or have an opportunity to increase those contributions, this is a good thing. Finally, Catherine, you said it is keep it between the lines, and I will probably forever steal that. About a decade ago, I was working with a gentleman during 2008 who had no changes in his life. He didn't get married, he didn't get divorced, he didn't have a baby, he wasn't near retirement. And he came into me and was just panicked about the markets and pulled all of his money out midstream and put it in cash in '08. And the next thing you know, the markets rebounded and he did not participate. So I really believe people should not change their stripes. A good zebra does not change its stripes. Rather, it stays the course and then evolves. That gentleman, if we were taking too much risk for him, when we got to market highs, should have maybe began to sell 15 or 20% until we got him down to the moderate investor he really should have been. So again, have a plan and stay the course if you can.
Absolutely.
I think that brings us to my...
Oh, go ahead. Q&A.
That brings me to my final slide, questions.
So can you speak, or are you in a position to speak about if someone was evaluating, let's maybe talk to both ends of the spectrum, someone that's evaluating opportunities saying, hey, you know what, I want to take a little bit of risk because of where I'm at in my life right now, and I have the fluidity to do that. I've managed my cash flow appropriately and I'm secure and I want to take advantage. Maybe talk to some concepts around that conversation. And then maybe on the opposite end, someone that says, you know what, I really need to manage my cash flow a little bit more. I don't have as much liquidity. I need to downgrade. I need to be less risky. Maybe just kind of speak to both of those.
Absolutely. So if you see opportunity in this and you are in a position to take advantage of it, I would look to a couple of things. First of all, right this very moment, we're using technology to work through that solution. And I love investing in technology here. It's approximately 20% on discount. And that doesn't happen very often for good, large cap kind of tech companies. So I really like that play. I like healthcare, but I will say I have some reservations around healthcare because the business model is forever changing. And in this moment, we aren't seeing elective surgeries. We aren't seeing some of the things where we might see profits in healthcare. So optimistic, but guarded a little bit there. And then I also like investing in the things that you spend money on. If you spend money on paper towels, consumer staples, that's a great place to invest. So I think those are some good opportunities in terms of sectors. And if you're looking for a little more risk in your portfolio, talk to your advisor about putting 10 or 20% to work in the dips here. As we go through this next month or two, you'll see some opportunities to buy things probably on an even better value than today, but also have a plan if the market begins to run away from you, that you say, based on a technical indicator or on a point total, we'll go ahead and invest 10% here so that you do take advantage of this opportunity. If you're on the other side of the spectrum, you've got too much risk. Remember that you've probably lived through 1 or 2 or 3 of these investment cycles before, and that if you don't need the money today, you're probably better off to weather this storm. The worst choice for folks usually is to sell into it. However, big asterisks here. You need to go talk to your financial professional. You need to get some advice, because your real challenge is your investments don't match what your gut feeling is. And that's when you lose sleep at night. If we learned one important thing from my father, who founded our firm, it's that money should always allow you to sleep well at night. I really feel the same about all investments.
I love that, Bill, because I'll give you some credit. I quite often take that same philosophy in my conversations. If it does help you sleep better at night, there's value to having the conversation, or not avoiding it. So I love that.
One final opportunity that I see out there that I think is a little more specific, and a little plug for my firm along the way. Here in Colorado, we have a tremendous municipal bond, and it rarely, if ever, goes on sale. Twice in my career now, and only by a few percent. But if you have monies that are one level past your rainy day fund, they're a capital improvement fund, or safe monies, but that you probably won't really use, this is a great opportunity to invest in Colorado and in bonds that are fairly safe and may help you adjust that risk scale to be a little more conservative, while doing a good thing here in Colorado and making a little double tax exempt, if in Colorado, return.
Good insight there. I have a question. Oh, go ahead.
Please go ahead.
Anything in relation to conversation around Fed rates? And, I think that that may be some, folks may have some questions around what that environment's like.
Those are great questions. So I often describe the Federal Reserve as a local fire team. There are 3 individuals, and those individuals have 3 jobs. One drives the fire truck, one empties the tanker onto the fire and holds the hose, and one has a shovel. The guy with the shovel is really good at putting out really small fires. And in this case, the Federal Reserve issuing funds directly to individuals and businesses is that gentleman with the shovel. The problem is he can't attend to many fires at once. The rest of the Federal Reserve, when their interest rate tank is high, have lots of fire extinguisher to put out on the fire. But right now they have almost none. As early this year, they went from about 1% down to almost 0 on their interest rates. This should make borrowing fairly easy. It should bring down interest rates. It should be pretty tough for banks in this moment. And that really is great stimulus. It's helped our economy not lose more and find footing. And I think we'll be there for quite some time. So this really is a great time if you're a first-time home buyer. Take advantage of low rates and go make it happen. One other side consequence I have to mention, kind of in full thoughts, we see a lot of pressure on the mortgage brokers, and those mortgage brokers are therefore increasing their standards a lot. So get ready for 20% and to prove your income and that you're still employed if you are a buyer out in that market.
Mm-hmm. Yeah, I'm glad you brought that up, because everything, these conversations start to intertwine with one another. And I know we've had offline dialogue about how is that going to look, and forecasting out with interest rates and what have you. So just know that we're going to be continuing to build on this conversation. I love the platform that you've set for the financing realm of things, and we'll be bringing on some of those mortgage brokers to come in and just kind of speak to some of the dynamics that I think you're starting to allude to relative to lending and rates, and just projecting that out over time.
Thank you very much. And I truly look forward to those experts. Honestly, that leads me to a great place to end it, unless there are other questions, which is I am a financial advisor, and we are great at helping people plan for their future and make their money work for them. But please speak with your tax professional, speak with your real estate professional, your banker, for better professional advice on those subjects.
Love that. So if people needed to get in touch with you, how would they do that?
Two ways. You can find us at clementsgroup.us, or you can find us at Bodo Drive, and our phone number 970-247-3794.
Wonderful. Thank you for talking us through. I love your stories and your analogies. I think it really helps to create something that is not as tangible for people that don't live in it every day to concepts that we can start to grasp and understand. So I really appreciate that. I am grateful for you, and have a wonderful Friday, everybody.
Thank you so much, Kathy.
All right, take care.